We got the FOMC minutes this afternoon, and the Fed is staying very accommodative. The federal funds rate has remained unchanged. Stephanie, QE, they're going to keep it at the current pace. What was your take on the whole statement?
Yeah, well, first they said the risks to the economy have gotten better, and so that's a good thing, or they've diminished. And then they also said the employment picture is getting better, which we all have seen, right? The one issue was that inflation has actually decelerated. So that's something to keep an eye on. To me, it sounded like I thought Bernanke did a pretty good job relative to his May 22nd speech, just in communicating about how they are going to keep the policy very accommodative for the foreseeable future. They're going to remain flexible. They're going to watch the economic data points to see if they can start to taper. And I think they're trying to get you set up so that they eventually will taper. It doesn't mean that it's next month or in a couple of months. I think that the 2% GDP for the economy kind of limits what they can do. They can gradually taper and reduce their bond purchases, but I don't think it's going to be material. And I certainly don't think we're going to feel it. And should the economy decelerate further from here, then they'll change. They'll remain flexible. So I think that that's actually a good situation.
How do you think investors and traders are interpreting this? The market's tanking. It's still not, there's no hard data point, like you said, of when the tapering is going to occur.
Right, so the markets don't like uncertainty. Now we're all wondering, are they going to do it in September? Are they going to do it in December? I think what's really happening is the backup in yields and the bond market. I mean, yields are up 12 bips today alone, and they were up 60 bips in the last month. So the rate at which the bond market is falling and that yields are rising is a little bit concerning, certainly. Does that start to eat into housing? Does that start to eat into consumer? I mean, these are two areas where the Fed said we're actually good. So we need rates to stay low. And so that is the data point to keep watching. The bond market for certain. I do think you're going to see a settling out in the next couple of days because, again, we are only growing 2% in terms of the GDP. And I don't see aggressive stimulus removal at this point. So, we're giving back what we had yesterday, and we've had a nice run, and so we're taking some profits.
Yeah, we were up 2 or 3% going into this announcement,
Certainly.
So that's okay. Now, you're buying AIG on the dip today. Like you said, the financials would be the one group that will benefit from an increase in interest rates.
I think so. I mean, the backup in the steepening of the yield curve certainly helps. The net interest margin in general for the financials. It also helps the portfolios, the investment portfolios at the insurance company. So we added AIG. We took our profits in Goldman Sachs. We still have JP Morgan and Wells Fargo and Key and still like them very much. I think you do want to be overweight financials in this environment, and particularly since this group has underperformed the broader average. It's kind of been flatlined since the May 22nd speech from Bernanke. So I think some of the valuations here make sense. I still expect restructuring both from Hartford and from AIG, and so we wanted to get more aggressive on the insurance side.
So on this pullback after Bernanke's speech and the Fed minutes, we are buyers of the financials.